Welcome to our video series where we're sharing insights on mortgage secondary and capital markets to curious loan officers and sales leadership. Before we get into the meaty topics that drive most of the questions that sales teams have for secondary, we need to continue building a foundation that we'll draw from in subsequent videos. In this episode, we'll introduce the important participants in the secondary market who play a key role in keeping the U.S. mortgage market liquid and thriving. We'll mostly be talking about agencies, aggregators, investors, and broker-dealers. But before we jump into that, we'll take a minute to talk about mortgage-backed securities, a common tie to all these parties. We'll wrap up by talking about why these counterparties are so important to the lender's ability to do business and how jeopardizing these partnerships could lead to competitive disadvantages. So let's get started. Before we talk about participants in the secondary market, I want to briefly introduce mortgage-backed securities, or MBS, because they're a commonality between all parties. Mortgage-backed securities are investments backed by mortgages. MBS enable investors from around the world to earn a portion of interest and principal received from the homeowner's monthly mortgage payments. Mortgage-backed securities are created when loans with similar characteristics, such as interest rate, terms, and product, are pulled together in a package of loans that can be sold to investors. As the borrowers of the loans in the pool fulfill their monthly payment obligations, these payments, after deducting servicing and guarantee fees, are passed through to the investors. This creates a steady and relatively predictable stream of income for the holders of the MBS. It also greatly benefits lenders by providing an avenue for them to move loans off their balance sheet, freeing up capital so they can originate more loans. MBS are traded on the bond market where they compete with other fixed income securities for investor attention. There's also a robust and liquid futures market for MBS in the form of to-be-announced contracts, or TBAs, which are extremely important for hedging a mortgage pipeline. There are two major categories of residential MBS, agency and not agency. We'll primarily be focusing on agency MBS as this is the largest market. While that was a brief introduction to an important topic, for now we're going to switch gears to talk about participants in the secondary market. But we'll be covering MBS and TBAs in much greater detail in the next video. Now we'll start introducing some of the parties in the secondary market. First, since we mentioned agency MBS, let's talk about agencies and enterprises, specifically Fannie Mae, Freddie Mac, and Ginnie Mae. Ginnie Mae and the GSEs play a significant role in the mortgage industry by providing liquidity to lenders and keeping home loans available and affordable. But there are some important differences between them. First, Ginnie Mae is a government-owned entity, while Fannie and Freddie are privately owned enterprises. Because Ginnie Mae is government-owned, it has the explicit backing of the government. This means if it faces financial difficulties, the government will intervene to support it. This gives investors who buy Ginnie Mae securities confidence that it's a safe investment, somewhat comparable to treasuries and other bonds. Fannie and Freddie have been under conservatorship and control of the Federal Housing Finance Agency, or FHFA, since the 2008 housing crash, but they're actively working towards exiting conservatorship. While under conservatorship, Fannie and Freddie also have backing from the federal government. Due to their significant size and critical role in the U.S. housing system, the U.S. government will probably always step in to provide assistance in a financial crisis. This is why even once Fannie and Freddie exit conservatorship, investors may likely continue to view them as having an implied backing from the U.S. government, allowing the MBS to continue to be viewed as a very low-risk investment. Another difference is that while Fannie and Freddie issue underwriting guidelines, Ginnie Mae does not. The underwriting guidelines and loan level criteria for loans making up Ginnie Mae pools are determined by the VA, FHA, USDA, and Section 184. Additionally, while Fannie and Freddie can buy individual loans and issue MBS themselves, Ginnie Mae cannot. Instead, Ginnie Mae relies on financial institutions with Ginnie Mae issuer approval to originate, package, and sell Ginnie Mae-backed securities to investors. Finally, the makeup of pools of GSE loans and Ginnie Mae loans differ. The GSEs primarily buy and pool conventional conforming loans, and TBAs for these securities are designated with a UMBS label. Ginnie Mae MBS consists of loans exclusively backed by VA, FHA, USDA, and Section 184. TBAs for these pools are given a GN or G2 label. The key similarity among all three entities is that they all guarantee investors will receive timely payments even if the borrowers default and fail to make their payments. This guarantee reinforces the reliability of agency MBS as an income stream for investors and allows them to remain competitive with other fixed income securities. However, it's important to know that they do not guarantee the pool's maturity, which we'll discuss in much greater detail in future videos. Aggregators are other entities that buy individual mortgage loans from various lenders and pull them together to create mortgage-backed securities, which are then sold to end investors. Some examples of aggregators can include Fannie and Freddie, large depositories, mortgage companies, mortgage investment corporations, real estate investment trusts, and more. Note that while Fannie and Freddie are often considered both agencies and aggregators, as a reminder, Ginnie Mae is not an aggregator as it does not purchase individual loans. Some viewers may be thinking that the definition of an aggregator seems to more closely align with what they usually refer to as an investor. It's very common in the industry for investor and aggregator to be used interchangeably, in reference to entities that buy closed loans directly from the lender. An aggregator can also be referred to as a correspondent buyer or a correspondent lender. So you may have heard something along the lines of, which investor has the best pricing? Often, in that context, the investor is technically an aggregator, although they could potentially be an end investor as well. For the purpose of this video on secondary market participants, just know we'll be using the investors only in the context of the entities buying MBS and receiving the monthly cash flow. There are many aggregators in the US, with Fannie and Freddie being two of the largest. As we mentioned before, Fannie and Freddie each have their own underwriting guidelines, and any conventional loan that meets their guidelines should be eligible for them to purchase. Compare this to aggregators who, in addition to the baseline underwriting guidelines provided by Fannie, Freddie, and the government agencies, often have their own overlays. These overlays are typically based on the aggregator's risk appetite or desire for certain pools of loans. In addition to purchasing conventional and government loans, some aggregators will also purchase loans that don't meet agency guidelines, such as non-agency or non-QM, with the intent to hold them in portfolio or securitize non-agency pools. Lenders often collaborate with multiple aggregators, usually to obtain improved pricing on rate sheets and premium prices at loan sales. However, having too many aggregator partners can sometimes work against a lender's goals. We're going to dedicate a video to this topic where we'll talk about some of the factors a lender should consider when determining how many correspondent lenders they should partner with to achieve their specific goals. Investors play a vital role in the secondary market by generating liquidity. In this context, investors are individuals or entities that purchase mortgage-backed securities. In the case of non-agency loans that are not pooled and securitized, the investor could also be the end buyer of individual mortgages with the intent to hold them to maturity. Some examples of investors who buy MBS could be the Federal Reserve, U.S. Treasury, international central banks, depositories, insurance companies, asset management companies, and mutual funds and ETFs, just to name a few. Lenders typically don't interact directly with investors, so we won't go into extensive detail discussing them here. Another extremely important participant in the secondary market are broker-dealers. Broker-dealers work with both mortgage lenders and investors, often serving as an intermediary between the two. While broker-dealers have many roles in the secondary market, in this video we're going to focus specifically on their relationship with lenders. Typically, the extent of the relationship between lenders and broker-dealers usually depends on if the lender internally hedges their pipeline and if they securitize loans. For example, lenders who don't internally hedge and don't securitize their own pools typically won't work directly with broker-dealers. Instead, they simply lock and sell their loans to aggregators who will manage those relationships. Lenders who internally hedge their locks will have relationships established with broker-dealers so they can execute TBAs and potentially other instruments used to hedge their pipeline. To execute these trades, the broker-dealer will charge a small transaction fee, typically around a plus, or said another way, 1/64%. There are several ongoing costs associated with hedging a pipeline, which we'll be referring to as hedge costs and transaction fees in future videos. However, just know the broker-dealer transaction fee is a fairly negligible portion of the overall cost. Instead, the majority of the transaction fees are due to bid-ask spread and drops in securities. The bid-ask spread are the costs associated with selling and buying back hedge instruments, while the drops in securities are the time element costs associated with trading into future months. We'll get into this more in future videos. Lenders who securitize loans will have even more interaction with broker-dealers. In addition to helping execute trades related to internally hedging a locked pipeline, broker-dealers play an important role in helping lenders find buyers for their MBS pools. This becomes especially important as lenders market custom or specified pools, as the broker-dealer's network of investors can help maximize the lender's execution and align the prepayment characteristics of the pool with buyers seeking this specific criteria. Many of these secondary market participants are considered counterparties to the lender. The types and how many counterparties a lender has often depends on the size and type of financial institution, if they internally hedge, as well if they have securitization approval. Another extremely important counterparty that is more relevant to mortgage lenders than depositories are warehouse facilities. These warehouse facilities provide lines of credit to mortgage lenders that allow them to fund loans. The capacity of the line and the borrowing costs offered by warehouse lenders are often driven by the perceived counterparty risk of the lender. But this isn't unique to warehouse facilities. Assessing the lender for overall risk is common to all the lender's counterparties. This measure of counterparty risk can directly or indirectly impact a lender's pricing and rate sheets, as well as their overall ability to do business. Each counterparty evaluation could include various types of risks, including but not limited to credit risk, interest rate risk, liquidity risk, as well as compliance and operational risks. Counterparty compensation to account for these risk factors can be in the form of worsened pricing on aggregator rate sheets, higher warehouse facility costs and smaller approved line amounts, higher broker-dealer transaction fees, as well as a lender's ability to gain and/or maintain agency issuer approvals. These higher costs can have a direct impact on a lender's profitability, which in turn will directly impact a lender's margins and could get passed through to the lender's rate sheets or to their fees. And lower approved warehouse or broker-dealer line amounts could have indirect costs if business is impacted by exceeding overall capacity to lend. Additionally, and while less common, if these counterparty risk tolerances are exceeded, lenders can lose these relationships, which can severely impact their ability to do business. The important note for sales teams is to be aware that while lenders will often strategically increase risk to do more production, there comes a point of diminishing returns where the counterparty and financial costs outweigh the production gains, and in certain cases can even threaten the entire business or jeopardize their counterparty relationships. The goal is to find the optimal balance to maximize profitability, appropriately limit risk, and maintain favorable ratings with the lender's counterparties. We hope this video provided you with more insights into participants in the secondary market and the important role these counterparties have in helping lenders do business. The lender secondary team will be managing many of these relationships and working hard to maintain strong partnerships so the lender can remain financially secure and competitive. In an upcoming video, we're going to be diving deeper into the topics of MBS and TBAs to prepare us to talk in more depth about hedging a mortgage pipeline, rate sheets, and other important topics. So please stay tuned.